would be a 25 basis point or a 50 basis point rate cut. This is what investors will find out this week when the Fed will finally conclude its policy meeting this Wednesday. The central bank is expected to start its easing cycle to deliver its first rate cut, and the question is not if, but by how much. Meanwhile, the Bank of England and the Bank of Japan will probably keep interest rates steady, but again, the debate there might be challenging as well. So starting first with euro dollar and the FOMC policy meeting, well, the Fed is expected to cut interest rates by 25 basis points, but futures markets suggest that the odds for an aggressive 50 basis point rate cut is high. So probably retail sales could affect market sentiment on Tuesday, but looking at euro dollar, it seems that it's already benefiting from a weaker dollar and on the back of a more aggressive rate cut in the US. The problem here is that euro dollar is around the 1.11 resistance territory. It's very close to these short-term resistance trend lines. So a break above this territory between 1.11 and 1.1140 might be needed to take us up to the 1.12 around level. Then above that, the pair will probably continue its upward pattern in order to reach the upper band of this bullish channel, currently seen around 1.1275. This is where the 61.8% Fibonacci tracement of the long 2021 and 2022 downtrend is located, as well as the that was also the peak from 2023, so that territory near 1.1275 will be important to watch in the future. Now, if you look at the technical indicators, there was some progress. The RSI is rising above its 50 neutral mark. The MACD is trying to reach its red signal line, and the stochastics have yet to reach their 80 overbought level, so the short-term risk is still skewed to the upside. Nevertheless, if the price pulls back below its 20-day moving average, currently seen around 1.1085, then the price may return to the 1.10 level, which it managed to pivot last week. Slightly below that, the 50-day moving average and this thin constraining line coming from April might be also important near 1.0980, while lower than that, the 50% Fibonacci of 1.0940 and the 1.09 territory could also attract attention. The 50% Fibonacci mark, as well as a couple of trend lines, including the lower band of this bullish channel, are located within the 1.09 territory. So there might be some congestion here before we head towards the 200-day moving average. Now turning to dollar yen. While the Bank of Japan is also deciding interest rates at the end of this week on Friday, expectations are for steady interest rates there, but probably investors would like to know about when the next rate hike will take place. For those who are not aware, the Bank of Japan has been increasing interest rates this year. So since inflation is above its target and interest rates are still very low, the Bank of Japan is pushing interest rates higher. Nevertheless, there is some caution there as well. The central bank wasn't very certain about when the next rate hike will take place, so any indications might cause volatility in dollar yen at the end of this week. Now, as regards the technical picture here, dollar yen hit a 14-month low 139.56 earlier today. It violated the base of December 2023, resuming its downward pattern, but it has yet to close below the 140 level. So if we manage to hold above that level, we may see an upside reversal, some recovery probably up to this descending trend line and closer to the 20-day exponential moving average, which is currently near 143.84. Above that, the 145 number could be important because this is where this broken support trend line is located. So a clear close above that territory might boost the market sentiment, likely taking us up to the 50-day exponential moving average at 147.65. Nevertheless, for an outlook improvement, the pair should cross above its previous high, above the 149.38 level, and perhaps also violate the 200-day exponential moving average near 150. So there's a long way until we reach that territory. Now on the downside, if the downtrend continues, I expect support to come somewhere between 137 and 137.80. There are a couple of trend lines within this region, so I would pay attention to this region before the 135.50 barrier comes into view. This is where another tentative support trend line is located, while lower than that, the 134 psychological mark could be the next target. We saw some consolidation around this region back in 2023. From a technical perspective, the market seems to be close to oversold levels, so I would rule out an upward move in the coming sessions. However, for an outlook improvement, we would like a strong reasoning to stage such a rally, and monetary divergence between the Bank of Japan and the Fed may not help this pair much, since the Fed is ready to start its easing cycle. And finally, looking at pound dollar, the Bank of England's policy meeting, interest rates are expected to hold steady there as well. But we may get more clarity when CPI data out of the UK when CPI data will come out of the UK on Wednesday. So if inflation slows down once again, pulling back towards the central bank's 2% target, then there might be more talks about a rate cut sooner than later. Policymakers suggested that rate cuts might come quarterly, so they were not positive for back-to-back rate reductions. However, if inflation data urges the need for a rate cut, we may see a pullback. And looking at pound dollar is close to a resistance trend line, as in the case of euro dollar. It's close near the short-term resistance trend line seen at 1.32. If we break above that, and if the price manages to close above the 2.5-year high of 1.3265, then the next stop could be near the 1.3340, where this strong resistance trend line is from May 2024 is located. Above that, perhaps the 1.34 psychological mark, which was a former barrier, could come next into view. Looking at the technical indicators, it seems that the bias is skewed to the upside. We see improvement in all indicators here, and the price is above its 20-day moving average, so the bias is skewed to the upside. Nevertheless, if the price pulls below the 1.32 level, we may see another test near the 1.31 territory. This is crucial because it includes this longer-term resistance line from December 2023. So failure to hold here could confirm additional declines, likely down to 1.30, where the price bottomed out last week. The 23.6% Fibonacci retracement of this up leg is located here, as well as the 50-day moving average. So failure to pivot here might extend the sell-off probably towards the 38.2% Fibonacci of 1.2890. We can see that there is another critical ascending trend line over here, coming from the low of 2022. That line is seen near 1.2815, while not far below that, the 50% Fibonacci mark could be another interesting area to watch. So let's see whether there will be a new bearish wave or a bullish continuation following the Bank of England's rate decision. So that's all I wanted to share with you guys. Thank you for watching and see you next week. Bye bye for now.